Mutual fund. Hi partners! Selecting the right mutual fund is one of the most important steps in achieving your investment goals, both for yourself and your clients. In this video, I'll walk you through some key factors to consider when selecting a mutual fund. First things first, remember that it's always ideal to create a diversified portfolio, rather than investing in a single fund. Diversifying across various types of funds can help reduce overall risk. So, consider spreading your investments across equity funds for growth, debt funds for stability, hybrid funds for balance, international funds if you are looking for global exposure. Now, there are two crucial aspects to selecting the right mutual fund. 1. Client profile and 2. Fund profile. Let's start with your client's profile. First, understand your client's investment goals. Are they looking to grow wealth over the long term, generate regular income, or save on taxes? Your client's financial objectives will guide you in selecting the appropriate fund. For example, if they're aiming for long-term growth, equity funds might be the right choice. If they need regular income, debt or income funds could be better suited. Next, assess your client's risk tolerance. Different funds come with different levels of risk. Equity funds are higher risk but offer the potential for higher returns. Debt funds are lower risk and offer stable returns, but with less growth potential. Make sure to choose a fund that aligns with your client's financial situation and risk appetite. Start by reviewing the fund's past performance. Although past performance doesn't guarantee future results, it's important to look at how the fund has performed over the last 3, 5, and even 10 years. Compare it with its benchmark and peer group. Look at how the fund performed during market downturns. A consistent track record can be a good indicator of future potential. Beyond past performance, a balanced approach to fund selection. Most times people consider past performance as the criteria. While it's an important aspect, it's not the only criteria to select a fund. Let me give you an analogy. When we drive a car, we have rear view mirrors. It only shows what's behind us. Past performance is history of the fund, not what ahead. We can't drive a car looking at the rear view mirrors. We also need to consider various other readings on our dashboard too. Yet we still need the rear view mirrors. The fund manager's experience also plays a crucial role in a fund's success. Investigate their track record and the funds they've managed. A fund manager with a strong, diverse history of managing funds across market conditions is preferable. Next, choose the fund category based on your client's needs. Equity funds focus on stocks, offering high returns with higher risk. Debt funds invest in bonds for lower risk and regular income. Hybrid funds combine equity and debt for a balance of risk and reward. Index funds track market indexes like Nifty or Sensex, offering low fees and passive management. Another important factor is the size of the fund. A larger fund generally indicates trust and credibility, but it's important that the size is optimal to allow for efficient execution of investment strategies. Also, consider the expense ratio. This is the annual fee for managing the fund, and it can eat into your returns over time. Look for funds with a low expense ratio without sacrificing performance. Metrics like alpha, beta, and Sharpe ratio can help evaluate a fund's risk and performance. Alpha shows how well a fund has performed compared to its benchmark. It helps assess the fund manager's ability to outperform the market in the long term. Beta measures a fund's volatility relative to the overall market. A beta of 1 indicates that the fund moves in line with the market. A beta greater than 1 indicates that the fund is more volatile than the market, while a beta less than 1 indicates that it is less volatile. Sharpe ratio evaluates risk-adjusted returns. A higher Sharpe ratio means better risk-adjusted performance. A Sharpe ratio above 1.0 is considered positive, while a ratio below 1 is considered low. Lastly, consider the reputation of the asset management company, AMC, managing the fund. A well-established AMC typically offers better transparency, risk management, and consistent performance. Here's a bonus tip: while it's good to review the fund's stock portfolio, it's important to remember that these holdings can change frequently. The portfolio you see might not be the one you are investing in, so it's more useful for existing investors. Selecting the right mutual fund is about understanding your client's goals, risk tolerance, and the various fund options available. By considering factors like performance, expense ratios, and the fund manager's track record, you can make an informed choice. At Wealthy, we understand that this can be complicated. That's why we've made it simple for you. With our Wealthy star ratings, you can rely on our research to make the best decisions without all the complexity. Thanks for watching. For more information, reach out to your RM. We are here to help you achieve your business goals with ease and confidence.